Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Nokia stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Nokia is a telecommunications, IT, and consumer electronics company. It is the largest Finnish company. They used to be the #1 provider of mobile phones in the world, but sold that part of its business to Microsoft in 2014. After the sale, Nokia began to focus more on its telecommunications infrastructure business and Internet of Things. It holds many patents and generates income by licensing those patents out to many mobile phone manufacturers. The company is headquartered in Finland and was founded in 1865. The ticker trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Zeta, Vienna, Swiss, Italian Bourse, Prague, Euronext, Paris, Nasdaq Stockholm, and Nasdaq Helsinki. Let's get started with the model. This is a large cap company, 26 billion market cap. They're trading at $4.63 a share, and they have 5.7 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their current CEO, Pekka Lundmark, took over in 2020, and he's done a lot of great things. So you can see he's already made the company profitable. They did have negative cash flow in 2019. He took over in 2020, it was 1.4 billion. 2021, even better at 2.2 billion. It did drop in 2022, a little under 1 billion. Since we're looking at the ticker that trades in the US, I converted all their financials from euros to US dollars. Net income is the profit or loss on the income statement. It's revenue minus expenses. They did have a big negative in 2020. That was an accounting thing. I think it was a deferred tax asset, but you can see they did generate positive cash flow that year. But they had a lot of net income in 2022, 4.6 billion. We'll look at their income statement in a little bit. Revenue is the sales for the company, and that peaks in 2022 at close to 27 billion. It was 25 billion in 2019, but what he did, he removed a lot of the unprofitable businesses and just focused on the profitable ones. So revenue went down, but cash flow went up, which is what you want to see, higher cash flow. This is the company's income statement. The top line is the revenue, the sales. All their financials are in euros. So they had 25 billion euros in 2022. So you can see their sales are all over the world. Of that 25 billion, 8 billion is in North America, 6.7 billion in Europe. They also do quite a bit in Asia Pacific, China, India. And when you compare 2021 to 2022, their sales are up in every category. It's up a lot in North America, 7.2 billion to 8.4 billion. It's only up a little in the other areas. In the fourth quarter of 2021, revenue in North America was higher than Europe, but now in 2022, revenue in Europe is higher than North America. The exchange rate also has a lot of effect on their revenue, because it is possible they did more business in North America, but if the exchange rate went the other way or went in their direction, that could also affect their earnings and revenue. Here's a breakdown of their revenue in a different way. Communications service providers is their biggest at 20 billion, then enterprise, licensees when they license their patents, and other. So since Pekka's been back, their year-over-year revenue growth has grown every single quarter, except the fourth quarter of 2021. But every other quarter, it's been growing year-over-year. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that peaks in 2022 at over 10 billion. You can see their revenue is only up a little bit when you compare 2022 to 2019. But look how much their gross profit is up. It went from 8.3 billion to 10 billion, while their revenue is up only 1.6 billion. So their margins are really good. Below that is their operating expenses. These are the expenses not directly related to generating the revenue, like R&D, research and development. Gross profit minus operating expenses gives you your operating income. and that went up 150% from 2019. It more than doubled from 2020, up about 50% from 2021. They paid 125 million euros of interest, which is a lot lower than prior years, about half of 2019. Other income and expenses, these are all the gains or losses not part of the company's core operations. Your pre-tax income, your taxes, and the bottom line of the income statement is your net income. So it looks like they had a tax credit of $2 billion in 2022. That's why their net income was so high. If I was to try to explain to someone this income statement, I'd probably ignore net income and just focus on operating income. That's a better indicator of how the company's doing. Because the company didn't really have a loss in 2020, even though the income statement shows it. They didn't lose money. The reason they had a net loss in 2020 was due to this large tax payment of $3.3 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they generate lots of cash flow now, a lot more than 2019. It looks like it peaked in 2021 at $2.6 billion. Then you have CapEx, investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. Now they're generating lots of cash flow. It was low in 2022 when you compare to 2021, but it's still a lot better than 2019. Let's look at the capital structure. 23 billion of equity, 6 billion of debt. They're 79% equity, 21% debt. And they could pay off all the debt with the cash on their balance sheet and still have 4 billion of cash left over. I gave them the middle whack on Finbox, 11.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 20 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $18 billion. We divide that by 5.7 billion shares. And we get a calculated stock price of $323. They're trading at $463, so they're trading at a 44% premium. It's a sell according to the model. Their revenue forecast for 2025 is 26.5 billion euros, which is 28.6 billion US dollars. For 2024, their revenue forecast is 28 billion US dollars. For 2023, it's also 28 billion. I continued this trend into 2026 and I got 29 billion. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. And they convert 6% of their revenue into free cash flow. So I multiplied their future revenue estimates by 6%. That's how I got their future free cash flows. So it looks like the company did a lot of dilution because they have a lot of shares outstanding, 5.7 billion. So it does seem like the stock is overvalued, even though the company has improved a lot. The website Simply Wall Street values the company $6. They're saying it's 25% undervalued. 3 analysts priced this stock and the average price target is $7. This is where the stock has been trading the past 5 years. So it looks like in the beginning of 2019 it was up to $6.50 a share. Then it did fall to below $3 during COVID, and it has doubled since that point, but the market has been coming down since the beginning of 2022. So it sits pretty close to $5 at $4.63. And they did bring their dividend back, which is nice. I'm sure investors are really happy about that. They currently pay 2 cents a share. Their last dividend was in January. That's a 2% dividend yield, which is 58% of their free cash flow, 12% of their net income. So it looks like they can afford that. They were paying 55 cents back in June 2014. This company used to be a giant. At one point, I think around late 90s, early 2000s, this company accounted for half the Finnish economy. Here's the dividend yield the past 10 years, and the yield was really high back in 2012, about 9.5%. It was 0 in 2020 and 2021. They did bring it back, and the forecast is for the yield to grow to 4.4%. So that's a good sign for dividend investors. And this is not a volatile stock. It has a low beta, 0.7. The stock has gone down 14% in the past 52 weeks, while the S&P is down 13%. The 52-week low is 4, the high is 560. And the stock is trading slightly below its 50-day and 200-day moving average. And this is a pretty popular stock. About 19 million shares are traded each day. Of the 5.6 billion shares outstanding, 4.6 billion are on float, 7% are held by institutions, and 1/4% of the shares are shorted. They've done 5 stock splits. It looks like about a 1-for-1 in 94, a 2-for-1 in 95, a 4-for-1 in 2000, a 2-for-1 in 99, and a 2-for-1 in 98. If you invested $10,000 into this company 10 years ago, you would have done decently. You'd be at $18,000 today. That's a 78% return, a 6% annual return. Pekka's annual salary is 1.3 million euros. And his total compensation package is 9.5 million euros. Half the company is held by the general public, 42% by institutions, 5% by venture capital and private equity firms, and 1% by private companies. Back in 2016, they employed over 100,000 people. That has come down to 87,000 people. Still a lot of people for Finland, which is a small country. But they used to employ a lot more people 20 years ago. The biggest shareholder is BlackRock at 6.3%, then Solidium Oy, that's a Finnish company, 5.4%, Vanguard, Norges Bank, and Artisan Partners. The best way to look at ratios to compare them to companies in the same industry. There are 65 companies in the same industry as Nokia, and if Nokia has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're the 3rd largest company on this list. Cisco is the largest at 200 billion, then Motorola, 45 billion, then Nokia. You notice I say Nokia. That's the way they say it in Finland. In the United States, we say Nokia, but it's Nokia. They spend more on CapEx than the average company, more than Cisco and Motorola. They have a really low debt to equity ratio. Look at Motorola, that's pretty bad at 10. They pay a nice yield. They generate lots of free cash flow, but a lot lower than Motorola and Cisco. They're the 3rd highest in market cap. They have really good price multiples, a lot better than average. They generate lots of revenue, triple Motorola, but they have really slim margins. Even though they generate lots of revenue, they generate less free cash flow. And they have a good ROA and ROE. So to summarize, I have them trading at a 44% premium, but things can change pretty drastically. If they knock it out of the ballpark in 2023, this may be an undervalued stock again. It is hard to predict the future, but this company's been around for over 150 years. They're the pride of Finland, so I don't think they're going anywhere. They're too important to the Finnish economy. I rank their free cash flow as 5 out of 10, their revenue 8 out of 10, and their ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.